Hello and a warm welcome to Econoday Unplugged on Wednesday, the 19th of May 2021. Mark Penders, stateside at Brian Jackson's in Sydney, and I'm Jeremy Hawkins in London. As inflation accelerates around the world, the debate about whether the rise is just temporary and attributable to one-off factors or a significant threat to central banks' price stability goals is getting hotter by the day. Just yesterday, former Treasury Secretary Larry Summers was laying into the Fed for being dangerously complacent over inflation in the States. However, given all the distortions to the data caused by COVID and oil prices in most countries, and also by changes in taxes in some, it's far from easy to say which camp is right. The coronavirus was, and of course, indeed still is, a shock to both the demand and supply sides of the global economy. Until the recovery in both is much more complete, underlying trends must remain highly uncertain, potentially making for a volatile fundamental backdrop to financial markets. In itself, that may encourage more central banks to go down the Fed route and adopt average inflation targeting. In any event, since this is our monthly global podcast, we thought today we'd have a go at assessing where inflationary pressures currently stand in the various regions and have a look at where prices might be headed. Normally we'd start with Brian, but after the surprise surge in US inflation reported last week, we'll kick off with Mark. So,
Okay.
Mr. Pender, inflation at its highest level since September 2008. Has the dovish Fed got it all wrong?
Not, they just issued their minutes from their meeting last month
Excellent
when they
timing.
were talking about. That's just today, just before we got on, and one part of that it brings up where they can, still hold the fort, and that is the one-time effects are going to be tied to this reopening. That's in its initial phases here. And so, it's not just the easy comparisons with last year, which is kind of soft ground. That's not firm terra. We're trying to figure out what current inflation is doing, but the idea that the comparisons now are going to be very, very high. So it already is with the April thing where we saw 0.8, if I got that right, a 0.8 monthly headline rise, which was 4 times the Econoday consensus. And
That's a big miss, isn't it? By
that's a huge miss.
forecasters?
Well, the 0.8 is like astronomical. Nobody would even come close to estimating something like that on the month. And the same with the core was up 0.9. And the annual rates, whatever that's worth for now, I mean, they're distorted, but right now it's 4.2 overall and 3% for the core now. But it's those month to month that's pretty scary now. But the minutes, if you look at those minutes from the point of view of it, like you're on the line that this is just temporary. Well, you can see, you can say like I said, hold the line there with the idea that this is going to fade once the reopening unfolds and establishes itself. And I guess presumably on the producer side, which is even skyrocketing further, that companies will not be able to pass this on successfully as well. But this, I don't want to digress too much, but now, Jeremy, you did the UK PPI today, right? And what was the output price? I mean, I think, I can't remember, but I looked at that and I was surprised. Let me see what I was surprised about. I'm looking at my Econoday calendar right now, going
Yeah,
to
I mean, we had
the
some.
UK PPI, and the output was up. 0.4%. I guess that's what the consensus was, but the input was 1.2. So, but anyway, that's the separation we're seeing here too in the U.S. is like this big, huge amount of input costs, but the companies are going to have to absorb them because they're
Yeah,
not
and
going to be.
that I guess is a big question about until such time whether or not we can see the increase in cost pressures actually feeding through into sort of final product prices. But it's quickly going back to the minutes. I mean, as we said, last week's number was a huge number, which may or may not be a one-off. We'll have to wait and see. But did the minutes sort of contain any indications that, if I just compare it to the ECB, within ECB governing council, there are clearly some splits now between the hawks who think, well, the There's no chance whatsoever, or there shouldn't be, of any further addition to quantitative easing. And indeed, we should really be starting to taper now. And those who think absolutely no way, the economy still needs support. Are there any similar sort of splits starting yet to appear on the FOMC?
It's not apparent yet. How have the votes been in the ECB? Have they all been
Well,
unanimous?
they come out of saying, the consensus decision was they don't actually give voting details.
Uh-huh.
So, I mean, just between the lines, it's quite clear from when individual central bank governors make their comments that some obviously think, really they should be thinking about tapering, whereas others, including Christine Lagarde, thinks, no, we need a very, very accommodative policy.
Well, that some and others construction you just mentioned is exactly how the Fed does it. So some say this and others say that. So it's hard to really. Sometimes they'll give you a larger clue, like several or something to or they'll give you some kind of. But that's not clearing up in the Fed speak. I'm not seeing any major dislocations yet. Everyone's still playing the party line here, and so. I don't know how long that can go on. Another a super strong inflation report would, and that's really the key. And you were talking about Larry Summers' his comments. If a Fed governor or president district president came out and said something like that, well, that would change things quite a bit. But that hasn't happened yet. So everybody is still on board the temporary transitory train.
Okay, in terms of that, the next set of forecasts from the Fed is at the June meeting.
Yes.
That's going to be, presumably, after this number, it's going to be quite interesting whether or not they actually come out and raise their inflation forecasts, or they got to try and talk it down somehow. Because presumably they can't incorporate that in the previous set. They can't assume that's going to happen.
That's one way they can do it. With the dot plots, you're anonymous and whatever. But you can see that. I think there was a little bit of a marginal movement toward the stronger side of the economy last time, and we may see that. But you're right. If that shows up, then those forecasts become political, and maybe people will hold back their forecasts. I don't know.
Interesting. Bron, talking of minutes, you had the RBA minutes out, was it a couple of days or so ago?
That's right.
Anything there to suggest that they're even remotely contemplating the idea about shifting policy yet? I mean, as in terms of towards the tapering or tightening?
No, not really. The debate is happening around the region, and it's probably happening here in Australia with the most sort of transparency and urgency about concerns about inflation, but nothing to indicate that the RBA has taken on board any real concerns about inflation. So just reading around the various news reports, there's lots of stories about pockets of price increases in parts of the economy. Some, in transport, logistics.
Can you just remind me where we set? You have an inflation target, don't you?
Yes, that's
Australia.
right. So they're aiming for 2 to 3%, and we're still way off that, and have been for some time, and they're not predicting it to get back there for some time. Basically, because wage growth is very very subdued here in Australia. Normally, we have wages growing at around 3 to 4% year over year, but that's completely gone down to around between 1 and 2% over recent years. And we had some numbers just yesterday, 1.5%, close to a record low of 1.4%. So wage growth very, very subdued, despite reports of some skills shortages in parts of the economy. You hear reports of in the hospitality industry, in farms looking for workers, can't get workers, but no sign yet that that's feeding through into actually increasing wages. And so, despite some reports and some complaints from people that prices are increasing in parts of the economy, the aggregate numbers are still very subdued, and policymakers expect that to continue. So we've had the RBA now for several months saying, we don't see any prospect that we're going to be tightening policy until 2024. We will start to see some indications that perhaps bond markets are pricing in an earlier move than that. But in response to that, we've had RBA officials come out very explicitly saying, look, we just don't see it. And we are not going to, this is the RBA talking, we are not going to move just based on inflation forecasts. We're only going to do it when we actually see the inflation numbers back within that target range.
So no,
and that's a change.
Then.
They used to act when they had their forecast showing inflation was going to be at such and such a level, but now they're saying we're going to wait until it actually happens.
It's interesting. It's like a shift towards sort of backward looking rather than almost forward looking. Oh, that's interesting.
Well, I think they've been burnt before, saying we think inflation's going to do this and it doesn't, and so now they're just saying we're going to wait until we see the whites of its eyes, I guess.
Yeah, I suppose you kind of wonder, don't you, because the economy is in such a desperate state, or has been in such a desperate state, that the last thing the policymakers want now is to be blamed for tightening too quickly.
Yeah. And so as I said, in Australia, we're probably seeing the argument play out with more transparency and clarity, but behind the scenes, I think this is what's happening in most of the region. No real appetite for tightening policy, and a bit of skepticism about perhaps there'll be some near-term bumps in inflation, but skepticism that we're going to see a really pronounced long-term increase in inflation, and so they're not moving yet until they actually see it.
Okay. Let me ask you about China. Obviously, the world's still looking at China to basically get global growth, well, together with the States now, obviously, to really get this global economic recovery going again. How are sort of inflationary pressures, I should say, developing out there?
Again, if we look at the headline numbers, nothing out of the ordinary. There could be some bumps associated with COVID and the base effects and food prices and Chinese New Year. So all these things are sort of in the mix, but no real sign that that the aggregate numbers are picking up very strongly yet. Again, there could be something in the works, and if we see inflation really pick up in the US, and that feeds through into sort of global prices, then eventually it'll have a bit of an impact on China, but not seeing it yet. And again, we don't have the People's Bank of China coming up very often with very clear announcements about what they're planning to do, but the basic message has been pretty consistent for a long time now. They want to keep supporting growth, and they're going to make sure that monetary policy is prudent, as they say. So prudent monetary policy, but still with an aim to supporting economic activity.
Right. I guess one of the sort of the countries in your at least the region you cover where tightening might have been a possibility would be India, where we do still have a relatively high inflation rate. But I guess that the COVID crisis out there effectively just rules out any kind of thought about that out anyway. Yeah,
I think that's right. They get a lot of volatility in their headline inflation number, mainly through food prices. Mm-hmm. And so the Reserve Bank of India tries to look through that when they're crafting policy, and they've been pretty consistent even before the latest surge in COVID cases in India that their priority was just supporting economic recovery. And I've no doubt that what's happened over the last couple of months there has just reinforced that assessment that they've got to just keep on supporting recovery. We haven't really seen the impact of the COVID crisis in the numbers yet, but it is likely in the next few months that we will see weaker activity as a result of what's been going on there.
On that front, can I ask you, do you think we saw, was it last year when we had when the COVID crisis first started, we had a period when some of the Indian data were being delayed, released late, or simply cancelled? Is there a possibility of that happening again?
Yeah, I guess that is a risk. A lot of India's economy is still based on agriculture, and so it involves officials going out to regional areas and collating data village by village almost, and so that could be disrupted by what's going on with COVID. So that is a risk, but again, I think RBI officials have a pretty good feel though for how the overall economy is tracking, and so they'll be pretty confident about assessing where policy should go. I think even if there is a little bit of disruption to some of the granular information that they get. So I guess the other big country to focus on is Japan. Mm-hmm. Still no sign of inflation. Pressures building in Japan. We've got uh, just late towards the end of April, we had the BOJ come out with its updated forecast. They're still expecting inflation to be well below their 2% target, right out into 2023. And so that's just, continues the trend that we've seen over 10, 15 years now. Inflation is still very, very low, stuck below that 2% level, except for times when they hike consumption taxes. And so again, no real prospect of a significant shift in policy in Japan.
And I've got to ask you about the Olympics, because it seems certainly over here, all the news coming out of Japan appears to be that, why on the earth they still want to hold these Olympics, and it seems like the majority of the population don't actually want them to. But does it look as if the Olympics will be going ahead as planned?
Yeah, I mean, I just read what people say in the press reports. Obviously, I'm not switched into what the Olympic Committee is actually doing, but it seems like it's going to go ahead. They're doing all they can. They're imposing states of emergency in Tokyo and other parts to try and really get a lid on it. So I think we're going ahead.
Okay, excellent. Anything else from your neck of the woods you want to put in the pot?
No, I mean, I think, as I said, the debate in Australia is sort of illustrative of, broader regional trends in what policymakers are thinking. No real appetite for changing policy at the moment. And so that's not to say there won't be a bit of a bump in some of the inflation numbers. We've definitely seen policymakers flag that they expect to see a bit of a short-term bump, but they're not really too worried at the moment.
Right. Excellent. Thanks for that. Okay, my neck of the woods then, I guess. Europe, I suppose, in many ways is kind of akin to where Brian's been coming from, in the sense that although the bond markets are intimating that increasingly they're looking at the inflation numbers, becoming concerned about them, in terms of the policymakers, and to be honest, really the numbers themselves, there's not too much to suggest that, at least for the time being anyway, inflation is a particularly big problem. So for the Eurozone itself, we had confirmation in the final April data earlier on today of an increase in the yearly headline inflation rate from 1.3% to 1.6%. So, okay, it's up from last time round, but it's still below the near 2% target. And anyway, more significantly, we actually had an unexpected down revision to the core rate. So the narrow core, which excludes things like energy, food, alcohol, and tobacco, the yearly rate there's dropped from 0.9% down to just 0.7%. Now, that's a 4-month low, and it means that the core rate has now declined every month since it peaked in January at itself a lowly 1.4%. And that, if people remember, was in part due to the reversal of the cut in VAT, which was implemented in Germany around the middle of last year. So really, if you put a straight line through some of these Eurozone underlying inflation numbers, they really aren't going anywhere in a hurry. And it really does, at least for the time being, give support to those more dovish members of the governing council, who quite simply think that if we do see a rise in inflation this year, it's going to be due to one-off factors, the weakness of oil prices last year, obviously all the distortions caused by COVID, etc. And those during the course of time will duly be unwound. So at the moment, anyway, it's got to be said that the pickup we've had in bond yields right across the Eurozone, and indeed the widening of Eurozone peripheral spreads, seems to have much more to do really with what's happening in the States and isn't actually in Europe itself. For the likes of the UK, it's a little bit different, I think, because the UK economy is really further down the recovery curve now. The vaccination rollout progressed that much quickly. It started that much earlier. And so expectations on the growth side now are a good deal stronger than we have with regards to the Eurozone economy. But the inflation numbers, again, they're still not doing that much. The April inflation numbers, the consumer price index we had out of the UK earlier on today, that moved up to 1.5%. That has more than doubled double the 0.7% figure we had as far as March is concerned. But again, it was largely due to the weakness of the inflation numbers, or the price numbers, I should say, a year ago, due to COVID and the collapse in oil prices. The core rate is still only running at, 1.3%. And in fact, if you kind of stick a straight line through what's been going on with the core, if anything, the trend is probably still down. And in any event, it's clearly still well below the 2% target that the Bank of England has as its target. So in other words, really looking across Europe as a whole, although markets are certainly talking about upside risk to inflation, it doesn't really appear to be coming through, at least in terms of the final product prices themselves. So if central banks are going to adopt, as Brian was talking about, the RBA attitude and simply saying, well, look, we ain't going to do anything until inflation really starts to threaten the targets, then it looks as if Bank of England, and indeed certainly, well, even more so, ECB policy could be unchanged for some considerable while. I guess if we're looking for an outlier amongst the kind of sort of central bank groups that we cover at Econo Day, it could be Canada. And again, I suppose you can put it into the kind of the relative outperformance in terms of inflation for the North American area. Mark's talked in previous podcasts about the strengths of the US housing market. And that does, in some sense now, appear to be feeding through into some of the Canadian price data. Now, just to put this into context, we had the Canadian numbers, which came out also today, handy day for the podcast. They showed an acceleration up, or above, where are we, up to 3.4%. Year on year for the
this is the CPI.
Yeah, this is the CPI in April, and that was up from 2.2% in March. And that's the highest annual rate, I should say, we've had since May 2011. Now, why was that? Well, as the statistics guys themselves are extremely keen to point out, I think this is true of most of the stats bodies internationally at the moment, in large part it was due to, a fairly sharp decline in prices a year ago. But also they did highlight the fact that lumber prices are going through the roof. And this is partly due to the fact that we have a housing market boom in Canada, but also because there's a housing market boom, as Mark's talked about in the past, going on across the border in the US. And a lot of Canadian lumber, of course, is exported into the US market. So that, I guess, is going to be something to keep an eye on. Again, as the way things are standing at the moment in terms of BOC speak, the attitude is that, well, they want to see unemployment come down further. They want to see a sustained recovery in place before they do anything on the inflation side. But they are, of course, talking about at least a possibility of a hike in interest rates as soon as the second half of next year. And that certainly appears to be a good deal earlier than what the financial markets are discounting, well, particularly as far as Europe's concerned anyway. So it may be that when we actually come to a change in outright interest rates, or an outright hike in interest rates, I suppose I should say, Canada could be one of the first to move. But by and large, I think just, from what everyone's saying today, there's clearly a question mark what Mark was talking about over what's happening in the States as to whether or not this April number is going to be a one-off or it is the start of something. But elsewhere, it really does seem to be the case that the general backdrop to price, it still remains relatively soft. There's obviously a huge amount of uncertainty just because of the way the data are put together at the moment due to the various distortions in the thing, which must say makes life very difficult if you're a policymaker. But pressure from inflation at this stage, well, it still seems to be pretty light. Does that other folks seem to agree with that?
Well, I wanted to add one of the one-time factors is this massive amount of federal stimulus for U.S. consumers, and it's driving up prices of vehicles, both new and used, and they can't make enough of them, but they're selling at 18 million annual rate plus. So that's a very, very, very strong rate, even though there's production limitations. But it's bleeding over to the used cars. And I was just out today for some anecdotal information, and the car lots are just about empty. It's hilarious. The showrooms are empty, and so. That I think is also part of the one-time thing we were talking about. But but I'd like to ask, and I guess I don't want to answer it. But what about the move today in the cryptocurrencies with China? What did they do? They
Well, it basically came out and made some regulatory statements. I think, one of the, the background potential negatives for, the whole boom we've had in the cryptocurrency market has been the fact that central banks have been looking at it for a while now. And at some point, most of them have made some comments to the fact there's going to have to be some form of regulation of the market, which simply isn't there at the moment. And I think China came out earlier on today and made some comments to that effect. The ECB has kind of hinted that it's going to look into it as well. Sweden ditto, and I think the Chinese
Sweden too.
Sweden are quite well advanced down the cryptocurrency route, certainly in terms of Europe anyway. I think
is this the beginning of the end for Bitcoin?
Oh, I'd never say that. I think a lot of central banks seem to accepting that the cryptocurrency will be coming about in some shape or form, but exactly what shape or form we really don't know at the moment. But I think
I guess at some stage that they want to be the ones in charge of
exactly that. Yeah, I think that's why I think the Chinese comments about, look, you can have a cryptocurrency, but it's going to be regulated. And at the moment, Bitcoin simply isn't. And I think the Chinese comments, I guess today, simply caught a market which is already, as we know, extremely stretched, and the volatility as a result has been left the currency all over the place. So yeah, it's going to be fascinating to watch what happens over the course of the next few days. Okay. Anything else or anything else? Anyone thinks inflation's about to go through the roof anyway? I suppose if it is, it's going to be you, Mark, isn't it? It's going to be your side. It doesn't look to be too much going elsewhere.
Yeah, running away in the USA.
Yeah.
Yeah.
Okay. Right. I guess we've been probably chatting for long enough. So everyone happy to finish it there? Silence is golden.
Sounds good.
Yeah, good. Okay,
Sounds
thanks
good.
both of you. Right, well, let's wrap it up there then. So on behalf of Mark, Brian and myself, thanks as always for listening. The podcast will be back next week. And in the meantime, you can, of course, find all the key market moving data and events listed and analysed in Econoday's global economic calendar. We'll see you next time. Bye for now.